Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul, what's going on?
Hey, what's going on, man? How was your trip?
It was great. It was great. So we got back from New Orleans. It's the first time I'd ever been to New Orleans. So just Hannah and I went there for the weekend, like 3 nights at an Airbnb. A guy we know here locally, it's his Airbnb. So that worked out really well. And great location, man. It was like 70 to 80 degrees every day.
Oh, yeah.
We left and it was 30 here, and we got home and it was like 23 last night. So, and I had to shovel my driveway again today. So it was great getting some warm weather and just having, 3 full days to do whatever we wanted or nothing at all. So
Yeah.
Cool town, man. I'll definitely go back. Just really unique, cool place. So
Yeah.
Awesome. I liked it. Yeah. What have you been up to?
Just buying things.
You on a buying spree right now?
Yeah, it's on a buying spree. No, bought our retirement land
Yeah.
in
Nice.
Lenoir City, Tennessee.
All right.
So we're gonna do the whole, finance the land, get a construction loan, and start building here probably in October.
Oh, really? And then
Yeah.
so it'll be ready by time you guys leave there?
Yeah, we'll probably end up staying here through the kids' school year 2025, I think.
Yeah.
Possibly. It depends with Tammy's career and some other stuff, but
Okay.
yeah, light is starting to see the light at the end of the tunnel. So
Yeah. Nice. It's good on the other side, brother.
I can't wait.
Man, I still got the guard, but that's 1 weekend a month.
Yeah.
Could do that standing on my head.
Yep.
So, yeah. Well, cool, man. Well, let's get into it. There's been a lot going on in the last week, in the last few days, really. But before we start, let's talk about the webinar. So at the time this podcast is published, that means the webinar is this week. So Get in the show notes right now, hit pause, go to the show notes, register for the webinar, and join us March 21st, 7 p.m. Central Time for just 1 hour of Q&A. Bring your questions, bring anything we've discussed that you want further clarification on or a deeper dive, and let's get into it. It'll be good. Well, all right. So, man, now this is funny. We're recording on March 14th. This is coming out next week, like on March 20th or something like that. Who knows what's going to happen between now and then? Like, we've already had 3 big bank failures, 2 since last Friday, from Friday through Sunday. 2 bank failures occurred, the second largest and the third largest in American history.
Isn't that crazy?
Within a 48-hour span. Yeah. Yeah. So
I was watching Bloomberg today in the gym, and the talking heads on there who aren't talking about the real problem, but they're talking about what they know, right? And they were showing like the treasury yields and stuff, and they're like, this is very similar to 2008. Different reasons though, and I'm just like, oh my goodness gracious. I'm like, it's going to keep happening.
Yeah.
Over and over and over.
It will. And who do they like to blame? They like to blame the consumer who's running to the bank to get their money because they're scared. That's who they blame.
Right.
No,
they don't blame our cartelized fractional reserve lending system that we exist under that, caused the cost of real estate to become unattainable for most people, drove up the prices of everything.
Right.
Oh, but it was COVID, Paul. Like, no, it wasn't.
Kept rates artificially low.
Too long.
Which, as we know, if you study Austrian economics, when the Fed artificially manipulates the interest rate and keeps it down and suppressed for such a long time, it sends false cues to business owners and corporations and even families.
No question.
Hey, you're stupid if you're not borrowing money right now. You better borrow, you better build, you better capitalize, you better, expand, because money is so cheap right now. And then boom, the rate shoots up, and now what? Now you got people with 5-year arms who are coming up on having to refinance. And guess what? The golden years didn't last forever. And now their monthly payment could double.
Yeah. And, I'm sensitive to the real estate thing because I'm actively involved in buying some, but I'm buying it from a couple. They're from California is what I was told. And the market there has changed. It's largely corrected. And now they can't, and interest rates are high. They can't sell. This is my guess. They can't sell their existing property.
Yeah.
Because it's priced out, with interest rates being at 6 to 7 for a 30-year note, it's priced out everybody. So anyway, the whole point is we don't have a free market for money in this country. We'll likely never see it, I guess, ever again. But things worked just fine before we had a central bank. Before 1913, things were just fine. And
yeah, since then
anyway.
It's been one depression or recession,
Yes.
one boom and bust after another.
So if you're looking for something to read, folks, I would go and I would definitely get into some Austrian economics. The modern guy is out there is Dr. Robert Murphy. You can read a lot of his stuff out there, but there's just so much, there's so much to know about it, but you'll know at least what's going on and why it's occurring.
Yeah. Well, so let's talk about the Silicon Valley Bank collapse, because I've already had clients texting me, sending me articles, being like, it sure is good to be your own banker right now. Moody's just downgraded the entire banking industry to unstable. So things are not looking good. But so in short, the Silicon Valley Bank, and I'm sure most listeners have heard about this. Maybe they haven't really done a whole lot of deep dive into it. But so this bank failed, collapsed because a good old fashioned bank run. Mm-hmm. So what's a bank run? You want to? Well, the first thing that came to mind is It's a Wonderful Life, like that part in the movie.
Dave is showing his age here, folks. If you remember that movie from the 1950s with Jimmy Stewart,
it's a classic. I was not alive when it was made.
I love that movie.
Yeah,
Merry Christmas, right? I love that movie, but so he ran a building, the old building and loan, right? And he, and there's a scene in there where things are, it's the Great Depression, and people coming in there. Everyone's got their money there, right? And he's like, well, your money's not in here; it's in Joe's house, and your money's in Bob's house, right? And they show at the end of that scene, like they put $1 or $2, I think it was $2 actually, into the little thing and locked the safe and shut the door. And but anyway, they made it, right? So, but that's what a bank run is. Everyone is rushing to the bank to literally get their cash, and of course, you can't go to your bank if you've got a couple $100,000 at the local, I don't know, mom and pop bank. Guess what? They probably don't have 200,000, and I'm making up numbers, but whatever amount in that vault to give you. They might, but they probably don't. Not if everyone's going to get their cash, right? So that's what was occurring. And of course, people can do it digitally, right? They can, sure. Of course, they can shut that down. Oh, the internet is not working right now at this bank.
Oh, yeah. Our website is having problems.
Website is having issues.
So you're saying if everything goes to crypto, or we get this crypto-based currency, they'd be able to just shut it down anytime they want, huh? Interesting.
Yes.
Yeah.
And that's, let's face it.
Yeah.
That's the goal, right? We're moving toward that, folks. And, at this point, I don't know if we can stop it, but.
So anyway, a bank run. So depositors wanted their money back because they heard there were problems at the bank, and they said, well, I'm going to get my cash out and move it to a more stable bank while there's still cash to be had. Well, what happens then is, if they even had 10% on reserves, meaning they had 10% of the deposits that came in still in the bank in cash, but more than 10% of their depositors wanted all their money back, then they're insolvent. They don't have the money to pay them back. So how did this happen? So this bank was bringing in a lot of money from all those tech companies, those startups in Silicon Valley, right? It was the darling of the banking world. In fact, Forbes magazine called it one of America's best banks just a month ago. in their magazine. How fastly have they redacted that magazine?
And what's his face there? Mad Money was telling people
Jim
just a
Cramer,
few
buy
days
their stock.
to buy it. And oh my goodness.
Yeah, it's called the Cramer
Swing and a
Index.
miss, buddy.
It's the Cramer Index. Do exactly the opposite of what he says, and you'll be just fine. Anyway, but so this bank, of course, they're not going to keep all the money there. They got to put it to work to make money, right? Get it making money for them. So they invest a lot in long-term treasury bonds. And at the time they were doing that, buying up all these T-bonds, the rates were very, very low, right? Artificially from the Fed. Yep. And then all of a sudden rates skyrocket. They jump, right? Triple in the last several months. And turns out now they have to sell those bonds for a loss because guess what? When the rates go up, a lot of people stopped borrowing money from the banks too. And they started actually just using the cash they had on deposit to pay their bills, to do their operations and fund their company instead of taking a cheap money loan to do that.
That's right.
Right.
Yep.
So now you got all these depositors coming in and taking more money out every month because they got to pay their bills. And the bank is sitting here like, oh, wow, we're losing a lot of cash. We got to sell some of these treasury bonds to get our cash back and get some liquidity. And then they tell everybody, it comes to light that, hey, we're selling all these bonds for a loss because, they're going for much higher these days. So who wants to buy a 2% bond, when you can get 5 or 6%? So they got to sell it at a major discount.
That's right.
And then that stokes the fears, rightfully so. Everybody wants their money out, and then all of a sudden you're insolvent because you can't sell enough of your assets to recover all the deposits that you owe everybody. So now your bank's insolvent. Yeah.
Yeah. Unbelievable though. And everyone's like, oh, we didn't see this coming. It's the same old story with these people too. We didn't see this coming. Oh, we need more regulation. Oh, because we deregulated or whatever. Right. This is the business cycle. Like you said at the beginning, Dave, the false signals, right?
Yep.
People were making crappy decisions for many years because money was cheap. And now the chickens are coming home to roost.
Yeah. And I don't know, the other articles I read mentioned they didn't even have a chief risk officer, a CRO, for like the last 8 months. And the one they did have before that was so caught up in these woke, company agendas that they were pushing, like Trans Day and all this other stuff.
Of course.
She was focused on that instead of, risk analysis.
Yeah, like doing the job she was hired to do.
Right.
And protecting the value of their shares and protecting their depositors, so there's obviously no interest in doing that. I also read that their CFO was held the same position at Lehman in 2008.
Oh yeah, like all their main C-suite staff, their pedigree was great, all from failed companies.
It's like, are you that hard up for talent that you can't go down to go down the street to Stanford and go to their MBA program, hey, anybody want to run a solid business for us?
Right.
No, there's no interest in that.
No, they'll take people who've already crashed and burned in one business and bring them over and let them do the same in another one. Maybe it'll be different this time, kind of like communism. So anyway, now the FDIC steps in, right? Because most of these depositors had way more than $250,000 on deposit. They had millions and billions. They were venture capitalist firms and tech companies. So, of course, they're going to get bailed out because they're elites. So, and of course, the FDIC and the Fed says, hey, don't worry. The taxpayer doesn't have to cover this bailout. Really?
No.
Where's the money coming from then?
Well, it's either going to come through the hidden tax of inflation when they create money out of thin air, just like they did during the pandemic. And although I don't know if they're in the position to do that at this point because their balance sheet from 2020 to 2022, 23 was, it's like a vertical, it's like pulling 9 Gs in an A10 going straight up in the air.
Right, and they can only handle 7.33, so it falls apart.
That's still a lot. We can only do about 2 before the blades
my
fall
body
off.
can only handle about 4. Yeah.
But anyway.
Well, so they do that, or they charge banks more fees to replenish the FDIC, right? To make up for it. Which,
Yeah,
what do you think banks are banks just going to absorb those fees and say, "Oh darn, I guess we got to pay more fees"? No, what are they going to do?
of course not. That's going to get passed on to the customers of the bank, right?
Exactly.
So, folks, it's never, the whole point is, right, this is never a surprise. You're gonna pay for it, whether you're a depositor or a taxpayer. You're going to pay for it,
Yep.
right? And that is the crux of this problem.
Yep. Like Nelson says, the consumer pays all taxes. What does that
That's
mean? It means you yahoos, you jackwagons who are saying, "Oh, tax corporations, make corporations pay more in taxes." Think through that. Just a couple steps. Imagine you owned a corporation and you had to pay more taxes. How do you think you would make up for that loss of revenue? You would increase the prices of everything.
That's right.
Which is exactly what they do down to the consumer. Boom.
Yep. And these, I use particular banks that are friendly to military, but I did bank with some other banks for different things over the years, and the fees are ridiculous. I was like, wait a minute, you're going to charge me a fee because I don't have a direct deposit every month?
Oh yeah, you know why they want that direct deposit every month? They can leverage the
They
snot
can
out
leverage
of
the snot of it, of
Man.
course. Yep. That was one of the big four, by the way. That's gotten in trouble many, many times over. Every few years they're in the news for billions of dollars of fines, which of course they can easily pay since they lend out money that doesn't exist. But anyway, yeah, man.
Yeah. Any bank that pays $1 billion fine does it with a smile on their face.
Yeah.
Because they made several more $1 billion doing whatever they were doing in order to get that fine.
Yeah, people don't probably realize it, Dave, but it's worth pointing out that banks make 2,000 to 3,000% a month.
Unreal. I mean, when you sell other people's money over and over and over, I mean, you sell the same money on a daily basis. It's
via the Mandrake mechanism.
That's another episode, I guess.
Yeah.
So that's the problem. So let's talk solutions. Let's before we even get into life insurance, let's talk about the FDIC insurance, because I think most people, I mean, you pull up to any teller, you drive through the bank and on the window or you go to the teller, it says FDIC, this bank is insured under FDIC up to $250,000.
Yep.
Now, what that means, folks, is that's $250,000 per depositor, per bank, per account type. Like, is it a CD? And maybe CDs aren't even covered, but is it, checking and savings? Is it a money market account? Is it a brokerage? Some other account? There's different types of accounts you could have. So every different account type that they segregate is protected up to $250,000. Every depositor is $250,000. If you have a joint account, like with you and your spouse, that's protected up to $500,000. What about people who have $1 million or more in the bank? Like, what should they be doing without bringing life insurance into it yet? What are some options?
I would spread that $1 million over to as many accounts as I needed to, so I was fully covered.
Yeah, and maybe different banks too. Like I'm gonna, hedge my bets and diversify, if you will, because who knows what bank is going next.
Yeah, because you don't want to put all your eggs in one basket. But it's worth unpacking the FDIC, and I'm glad you brought it up because I forgot. I had a brilliant thing to say about it, and it's worth for folks to look into. Is that the FDIC is not real insurance, folks?
No.
If it were, it would be effective, meaning risky banks, that are assessed as high risk, their premiums would be higher, wouldn't they be, Dave? Just like if you were, if you had 3 DWIs and I had a perfect driving record, your auto insurance would be a lot higher, right? Because you're a higher risk, right? And mine would be lower. And that's the way real insurance would work. But it doesn't work like that with the FDIC, right? And of course, those fees that they pay get paid by you, the depositor, because you're getting those fees passed on to you by the bank. So
what you're saying is, regardless of the driving record, every bank pays the exact same amount in insurance, the same insurance premium, right? Which makes no sense at all.
Makes no sense.
And if you know, well, my depositors are covered up to 250,000, what's to stop them from taking risks other than they don't want to fail? Like no bank wants to fail, but they're definitely, they're kind of encouraged to take more risk if they don't have to pay any extra to take that risk.
Well, that's the thing. If we're going to have this lender of last resort, the taxpayer is going to bail them out. Either, they don't say it's a taxpayer bailout. It is indirectly. Then what's the incentive to be an honest banker?
Right.
And not take risk and not take gambles. Well, there is no incentive. It's like, hey, oops, sorry.
Yeah.
So anyway, and of course, the FDIC, last time I checked, had less than 1% of its. There's trillions of dollars of deposits in the banks, right, Dave? Of just people, normal people, right? There's 30 million Americans or whatever. There's trillions of dollars in deposits. The FDIC can meet about less than 1% of its obligation to you.
Right. Yep. You can look that up. That's a public number.
Yep. And that's fairly close, folks. But last time I checked, it was about that. So you're not protected.
Yeah. So even if the Fed came in and bailed people out who, say several banks failed and a lot of people lost a lot of money, FDIC ran out of money, they become insolvent. The Fed steps in and prints a bunch of money. We all suffer anyway, right? It's just more inflation.
That's right.
Yeah. So, okay. So let's talk some other practical alternatives. Let's pretend people don't have, aren't familiar with life insurance and the thing, we're going to get to that on why we put our money in life insurance companies and why we think they're much safer and why in fact they are. But some other alternatives people could look into: credit unions. I like credit unions. They're nonprofits. And you're actually an owner, kind of like a mutual life insurance company. I'm an owner of the company because I'm a policy holder. Credit unions are owned by the members of the credit union. And they don't have FDIC insurance, but they have something that's exactly the same. It was created, decades ago and has the exact same stipulations, 250,000 per depositor per account.
Right.
So yeah, your money's still just as protected there, maybe more so, because actually I didn't look up to see what kind of reserves that organization, like the National Credit Union Administration, has.
Yeah,
we could probably Google that, but maybe they have more than the FDIC as a percentage.
You never know. I have this feeling that it's like the same.
Yeah,
but
probably.
I don't know.
Yeah, but I don't know. I also like credit unions because they're a lot more personable. And this is funny. The first credit union I signed up for, maybe like 5 years ago, I just had starting a business and hadn't really shown much of a capability yet. But they're like, "Hey, do you like hockey?" "Sure." They're like, "You want to go to a NHL game with us?" "Yeah, I do." So my brother and I went with them, and I got to see my first NHL game, and they pay for drinks and food, and after they were like, "See you later." It was cool. They wined and dined us.
That's crazy.
They're all about like building relationships. They were going to give me like a $20,000 loan on my like 7-year-old F-150 at 3%.
It's pretty good.
Yeah. So I was like, yeah, these are credit unions are cool. I don't want to, spend too much time on them, but if you have one in your area, there's one you can be a part of somehow. So maybe look into that as well. So, or what's the real alternative for where to store your capital?
Mutual life insurance company.
Right. A well-run mutual life insurance company with good industry rankings and, in my opinion, a 100+ year track record of paying dividends.
Yep.
I mean,
no
why
question.
not? Like, there's plenty of them out there that have more than 100-year track record.
Yeah, there's a bunch, and we have our favorites that are geared more to IBC, but certainly take a look at them, and you can look at their financial rankings that are out there, public knowledge. You can look at what they often refer to as their Comdex score, which is kind of a aggregation of a bunch of different scores from the different rating agencies.
Right.
But you can look all that stuff up, and something over 90 is probably good. Something over 95, that's probably where you want to be.
Yeah, why not? because there are some very solid mutual life insurance companies there. So how safe are life insurance companies, Paul? Now, when I ask that question, the response is, well, compared to what? So let's compare life insurance companies to banks, because that's where the majority of Americans keep their money.
Sure.
So let's dive into some of the reasons why we think life insurance companies are the safest place to keep your money outside of a built-in fireproof safe in your house, where it's not going to earn for you. You can't leverage it. You can't do anything with it except store it. But anyway, compared to banks, why are life insurance companies a better place to store your capital?
Well, specifically, and I'm going to focus on the mutuals because that's who we use. But generally speaking, insurance companies are very stable and very profitable businesses. But I'm going to focus on the mutual life insurance companies. You can go back and look at the history, Dave, of during like the Great Depression, for example, where there were thousands of bank failures. Hey, you can go to the savings and loan fiasco of the 80s, right? Same kind of scenario, right? Banks were failing, these savings and loans were failing left and right. Well, mutual life insurance companies, and there's some big ones, and there's all different sizes, but they're very, very stable. And part of that reason is that they're not beholden just to stockholders. So they're not always trying to do these risky things to generate a return, to make their stock more appealing so people buy more of it, right?
Right.
They're not doing that. They have a long-term outlook so that they can meet their obligations 20, 30 years down the road and beyond.
And what are their obligations based on?
Are you saying like guarantees or?
Yeah, like how do they determine what their future liabilities are going to be? Like in the next year, how much do we have to pay out in death benefit?
Right. So they use, I think you're getting at actuarial science.
Exactly.
Right. And so folks, what actuarial science is, and it's the same thing with auto insurance or homeowners insurance or whatever, but they use the law of large numbers, right? So they might take 10 million lives of a selected group of people, like healthy 43-year-old males, right?
A couple.
Yeah. Like this handsome fella right here, right? With that beautiful hair. So you take Dave, right? Healthy guy, works out, doesn't really eat much. I do all the eating for him because I really like food.
Although New Orleans, I'm
get some of that Cajun food.
That was good.
Yeah, yep. There's some Frenchies. There's a lot of Frenchies down there. Anyway, you take those lives. So the life insurance companies know really down to a very accurate number of how many people of that selected group are gonna die in a given year. They know.
Right. Yep.
Right. So that's how this business really works, right? And they over-engineer the policy or the policy design, right? So and Dave Ramsey kind of gets into that with like, they're overcharging you for insurance, whatever. He's not true. They build it so it's very so they can meet their obligations. It's conservatively designed and with a reserve in mind. So that's kind of all over the place, but actuarial science is the bottom line. That's how they do it.
Yeah, it's based on the science. So it's not based on modern money theory or what our fractional reserve banking is based on the assumption that not everybody wants to come and redeem their cash at the same time.
Right.
However, when that happens, banks go insolvent. It's impossible for them not to.
That's right.
Because they don't have the reserves to pay everybody.
Right.
Yeah. So yeah, you're right. And even over so some stats we pulled up, like during the Great Depression, there were failures of insurance companies, but 14% of insurance companies failed and 38% of banks failed. Over 9,000 banks failed during the Great Depression. However, that 14% of insurance companies that failed, that number also includes many companies that were just taken over by larger, healthier insurance companies, which is usually what happens.
Yep.
So that doesn't mean that 14% of people just lost everything. In fact, it's been said, and I've never seen, I think Carlos Laura wrote this in an article, and he admitted he'd never seen any evidence to refute this statement that even during the Great Depression, not a single policy owner lost their policy.
Right.
So those assets still remain intact. Death benefits were always paid out during the Great Depression. Nobody ever did not get a death benefit paid out during that time.
Yeah, and that's super important, especially during times like that. I mean, it was an awful time and of course the government got involved and made the Depression even worse.
Way worse. Thank you, FDR.
Way worse. I mean, it was just terrible.
It was already recovering before FDR started interfering, and then all he did was, like Obama did in 2008, just slowed the recovery. That's all he did.
That's correct. So again, people are all emotional about this bank, and my recommendation is to do nothing.
Do nothing.
Do nothing.
Yeah, let the market figure it out.
The market will figure it out. Yeah. But of course, we can't do that.
No, because
there's politics involved, and
they have to justify their existence.
Yep, that's right.
Yeah.
Anyway, but no, you bring up a great point, Dave. It's you and I, we're infinite bankers. The only money we keep in commercial banks is what we need to transact our monthly lifestyle, right?
Yeah.
All of our other money gets thrown at a mutual life insurance company, doesn't it?
Yeah, absolutely. I mean, I had this conversation with a client today while I was shoveling the driveway. I just made the point that, dude, anytime I have excess cash, more than what I need to pay my bills in the next month, that's going back towards my policy in the form of either, premium, paid up additions, or repaying an outstanding loan.
That's right.
That's it. Like, that's where the money goes. Even during the Great Recession of 2008 and the aftermath from 28 to 2010 or whatever, over 500 banks failed.
Yep.
And from what I could find, only 19 insurance companies failed. And most of those had pretty low Comdex scores anyway, to begin with.
That's right. And, we had a recent one in the last couple of years who's the last time I checked it before it demutualized, the Comdex score was 73. And I remember thinking back then when someone was telling us to use it, and I was like, why?
I wonder, it'd be interesting to see the history of that Comdex score, if it was always that low. I don't know.
Yeah,
I don't know. Over the years.
And the other thing we have to, the trusting of the rating agencies who completely turned a blind eye in 2008 because, hey, if we don't give them, if we don't rate these bonds, and then they're, we're going to lose that contract or whatever. So there's, a little bit different than the life insurance industry probably, but still, do your job. Yeah.
Do your job. Be honest. They're all supposed to be independent, but I don't know. It's hard to believe anybody's independent these days.
It's, I think the word is ethics. We have to take 6 hours of ethics every 2 years or something. And, as producers, right? So, these people should do the same, like remind them, like, hey, you're here to protect the consumer.
Yeah. Well, so let's talk about how the differences comparing insurance companies to banks, and just how they're regulated.
Yes.
Reserve. So banks, there's a reserve that they have to maintain. Historically, it's like 10%. People say 10% reserves. We just use that as the typical number, but those reserves have gone all the way down to like 0 before.
Yeah.
Where the Fed says you don't have to maintain any reserves whatsoever. You can loan out all of your money. Life insurance companies can't do that. They cannot play fractional reserve banking and loan your money to other people and create money out of thin air, like our centralized banks do. Right. So they're highly regulated at the state level. They have to maintain enough assets to cover their liabilities.
That's right.
So, yeah. So let's talk about their investments, right? They're not just sitting on a bunch of cash. Like, they have some money in cash, not a lot though, but their money is in liquid investments and like investment grade bonds predominantly, like heavy into long-term bonds.
Yep.
Right. But people are like, oh, wait a minute. Wasn't that what SVB was involved in? The long-term bond, the T bonds. And then they got in trouble when rates went up. Yeah. Well, Life insurance companies, again, it's based on actuarial science. They know in the future, hey, 10 years from now, we're going to have like this liability with death claims, right? So we need bonds that mature 10 years from now, and we need this much money available. So they're able to play it like that.
That's right, Dave. And they have sequences, right? So they have different blocks of money that are maturing at different times.
Exactly.
Right. Every year they probably have a block.
Probably.
Depending, you know what I mean? And right now they're probably buying some of that longer term stuff because interest rates are up. They haven't been this high in a long time. My first mortgage in 2006 was 6.375. And that's just what it was. And I wasn't like, oh my goodness, this is so high. You know, all of you people have been spoiled.
Oh, we've all been spoiled. Yep.
You know, but
Yep.
I'd rather have anyway. But anyway, that's the whole point, right? So they're playing chess. They're not playing checkers, right? This is not their first storm to weather. They weathered a low interest rate environment for many years. Let's face it, rates were low on average for the last 20 years. They've been ridiculously low. So,
they still paid out dividends every year.
Yes, that's right.
They still met all of their liabilities, even during COVID, when one mutual company talked about a 40% increase in death between a certain age range.
Right, and that number was actually the way it was deceiving. Anyway,
yeah, but it would take a lot more than that to make a company insolvent. I think that CEO got up and said something like, even if it was 200% over what we expected it to be in a given year, we'd still be okay with the reserves they have.
That's right.
Yeah.
These companies, they're not over 100 years old and have paid a dividend every year. They've been in existence for a reason because they're doing it wrong. They've been doing it right despite government regulation and despite, market manipulation by the Federal Reserve of interest rates. Somehow they've been able to really just adjust and flex and really do a good job to protect us, the policy owners, who are part owner of the company.
Exactly. So another thing that's really interesting when you compare insurance companies and banks, commercial banks, is like the risk profile. Like we already stated, the risk profile of a bank doesn't matter when it comes to how much premium they have to pay the FDIC to cover their risky bets. Life insurance companies, on the other hand, there's a risk profile. They're being regulated, they're being looked at, they're being analyzed. And if they're making riskier investments, then they have to hold back more in reserves.
Yes, that's correct. And that's as it should be. And Dave mentioned earlier that they're regulated heavily at the state level, which is why they're able to just look closer, right? I work in the federal government. It's a huge machine, and I just am in the Department of Defense sector, right? But it's a huge machine. There's no way they can look at everything all the time in detail. And maybe they don't want to because, hey, their buddy that they went to Dartmouth with is actually the CFO at this company that, anyway. Yeah. There's all that going on behind the scenes as well.
Right.
But in their obligations to the stockholders, like we said earlier, our obligation, the mutual companies, they're obligated to me, the policy owner, right? And that means something to them, especially these companies that we work with they really do care. They want to pay out that death benefit. They want to pay out that dividend. And I think that's a huge difference. Like these banks, there's certain people and they're just, I hate to say they're greedy, but they're dishonest and greedy.
It's human nature. They're very disconnected from the actual client, from the depositor. Like you're just a
number.
You're just a number, not even a name, right? Yep. You hardly even, who goes into the bank anymore? Like eventually they're going to stop they did it for a whole year with COVID. You couldn't even go into the bank. I went into a bank wearing a mask, asking for money. That was pretty fun. But you couldn't even go into a bank. You just had to go through the drive-through and, everything's online. Now, insurance companies, they got online stuff, but insurance companies are very, I don't know, the leaders of the insurance companies that we write for are very in tune and involved with us. They're available, through text message if we have a question or a concern about anything.
Yep, that's super important. You're not texting, the vice president of Capital One.
Well, actually, everybody at Capital One is a vice president. Have you noticed that? Every time you walk into a bank, they're a vice president.
Everyone's a vice president.
Yeah, you're right out of college, man. You're a vice president at a bank. That's a big deal, right? No, they
comes with 3 Joseph A. Bank traveler suits
for $99. Hey, don't knock Joseph A. Bank.
My suits are. I said that. That's exactly the suit that I have. Yeah, 38 Slim Joseph A. Bank.
Yeah.
Yep, and they're just fine. They look great.
Yeah, they do. You probably never wear them, so I'm sure they stay in great shape.
I'll see them. You'll see me wearing them in Canada.
Oh, do I need to take a real suit for that?
Yeah.
Okay. Just one? Maybe I'll get a second one.
Do what your career can handle.
Yeah. I'll let the wife shop for a suit. She loves.
There you go.
She loves dressing me up.
Yeah, go to Joseph A. Bank.
Joseph A. Bank. All right, I will. Been there before.
Mm-hmm.
And they're not cheap like you think they would be.
I got 3 for $750 like in 2015, so that was a long time ago.
All like custom, like they tailor them too.
Dude, right off the rack, all they did was tailor the pants for my height, but the jacket was right off the rack, perfect.
Nice, and it still fits.
Yeah,
good job, Paul. Not a lot of guys can say that at the end of their military career.
I still wear my original dress blue pants. Are my original dress blue pants that I got in 2002.
Me too.
Mm-hmm.
Me too. There's not many of us out there,
but they are tight.
Well, you just filled out.
I did. I filled out a little bit.
Yeah, I finally filled out.
Yeah.
Well, anyway, what other comparisons can we make? I think we hit some really good comparisons.
No, I would just focus on, life insurance companies. They're not banks, so totally different set of rules. They think long range. They're not worried about like making a return for their stockholder right now. State regulated, different reserve requirements, heavily regulated on what they can actually invest in. Right? They're not out there. They can't go out and buy 50% of their portfolio can't be in securities. Right? It's actually a very tiny amount actually.
Yeah.
Very conservative. Very conservative.
Yeah.
And again, it's just good business based on good science. Actually, let's see, follow the science, right?
Trust the science.
In this case, you can trust the science because it's actually science. It's not this made up crap we've seen the last 3 years.
That you're not allowed to question. Yeah. No.
Anyway,
this is true science. And, I've never heard of a bank run on a mutual life insurance company. Right. No. I'll give credit to Ryan for posting that, but I thought that was a nice good quip. Never seen a bank run on a mutual life insurance company.
Yeah.
Because guess what? I'm first in line. I can go anytime, get my money. I'm first in line.
Yep. And just a reminder, folks, right? I'm part owner of that company that's going to pay me a dividend. I want it to be profitable. It is profitable.
Right.
Law of large numbers. It's going to continue to be profitable. Through all this crap on the side is just noise, right? We're talking about it because a lot of you have reached out to have us talk about it a little bit, but there's a reason all my capital is over here and not over there.
Yeah. I'd be interested to see if if outstanding policy loans are being repaid much quicker in the last couple of days because of those bank failures. Like that. Again, folks, if you have a policy and you have available paid up additions that you could fund this year remaining, if you don't know, just call the company and say, how much paid up additions can I put in for the remainder of my policy year? And they'll tell you down to the penny. Yep. Or if you have an outstanding policy loan and you have cash sitting in somebody else's bank that you don't need in the next 30 days to pay a bill, you better be putting that back into your life insurance policy. We warned you right here. I'm not trying to scare anybody, but why would you not? Why would you want to keep that money exposed in a commercial bank when you have the perfect, safe place that you've already created in which to store that capital? Just put it back.
Yep. And we've covered that before. There's no reason to do that.
Yeah. Because you can access it, you can take it, take a policy loan at any time if you need it.
That's right.
Even during the Great Depression, they were allowed to take policy loans.
Yeah. I just took a bunch.
Yeah. So did I. Yeah. Yep. So hopefully that should pay off quite nicely.
I touched almost every policy, actually.
Yeah.
They kind of spread the wealth around,
Spread the wealth.
Yep.
Oh, speaking of, I saw. Okay, this is the last thing. We're going a little long here, but I wanted to state this. I took a picture of it too. It was I was at this art it was an outdoor art street or whatever, and there's just all kinds of crazy stuff around in New Orleans. And there was a banner there, and it said, "We don't spread wealth, we recycle it." I was like, that's awesome. I love recycling wealth. I'm recycling. I'm using the same dollar over and over and over to grow my wealth. And that's exactly what I do. I think they were probably talking about it a little bit differently. I didn't want to get in a conversation with the hippie behind the counter about it, but I liked it. Like, that could be our motto if we didn't have a better one already.
Do they have Birkenstocks?
I didn't look at their feet. It was crowded. I wouldn't wear sandals in a crowded area.
No.
So,
nope.
No. But there's plenty of Birks around Minnesota, man. Everybody wears them. So, and they're not all granola either. Like, it's just
granola.
It's
there
like
it
the
is.
Fashion thing out here.
The granola shoe.
Yeah.
Have some Birkenstocks with a side of quinoa.
Yeah. All right. Well, I think we'll end it there. If you didn't listen to us at the beginning, go ahead, go to the show notes, register for the webinar coming up this week, and we look forward to seeing you guys there. And until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.